And so with that, let's just jump right in, and we'll do some quick introductions. Todd, if you would, please introduce yourself to the audience and just tell us who you are and a little bit about yourself.
Sure. So Todd Chapman, I'm the president of JMA Ventures. We're a San Francisco-based investment and development firm. Been around for about 30 years. We entered the opportunity zone space really, I guess, the beginning of 2018. Closed our first single asset deal towards the middle of last year, and just began raising a multi-asset fund here at the start of this year.
Good to have you. Erik?
Hi, I'm Erik Hayden. I'm the president of Urban Catalyst Opportunity Fund. We are a Bay Area-based opportunity fund, focusing specifically on Bay Area properties. We put together a great team of development professionals at Urban Catalyst, and we're raising a fund for $250 million. That's our cap. We started fundraising on January 1st. It's a multi-asset fund.
Great to have you. Jeff?
Good morning. I'm Jeff Diener. I'm a partner with Paul Hastings. I'm based here in San Francisco. We help our clients buy, sell, finance, develop real estate assets around the country and around the world. And very, very happy to be here today.
Wonderful. Good to have all of you. I look forward to the conversation. I'll let you guys take it away.
Great. Thanks, Nick. So, I'm sitting here with two pioneers in the opportunity zone world. So starting off with just sort of a real basic point with respect to opportunity funds. If you have an investor, they hold the investment for 5 years, they get a 10% step up in their basis. They hold for 7 years, they get another 5% bump, so a total of a 15% step up in basis. And the issue is the hold period is calculated on the earlier of the sale of the investment in December 31st, 2026, which means in order to maximize benefits under the Opportunity Zone program, we've got to invest by December 31st, 2019. We're already here, February 2019. Erik, how is this deadline impacting your investment strategy?
So obviously we've taken this deadline into consideration because it is an important advantage to be able to get that additional 5%. The hard date of December 31st, 2026 and having to have your money in the fund for 7 years to get that advantage, the way that we're dealing with it is we're only raising money for our fund in 2019 to really maximize the benefit to our investors.
Todd?
A little bit of a different approach. We're telling investors, including those that invested in our first single asset fund that would benefit from the kind of the maximum deferral period, that's really kind of a secondary benefit. It certainly is an important one to kind of get the deferral and the 15% step up, but really the folks that we're talking to on the private capital side are focusing on that longer term benefit, the elimination of capital gains after year 10, which again brings us back to the beginning of the project and making sure that we as an investment professional team are focusing on the fact that the projects we invest in, be they QOZ or not, need to be good projects. Because if they're not a good project, there is no gain. If there's no gain, there's no real benefit to the platform. So that's how we're focusing on the issue.
Great. And then a related question related to how the program might be viewed by your potential investors in your funds. Right, in order to defer the capital gains on an asset, your investor has to, within 180 days of the sale of an asset, invest in the fund. So some of your investors, I presume, might have one sort of big slug investment that they want to invest. Other investors might have investments that they're sort of realizing the gains over a period of time. Todd, how's this impacting your fundraising?
You probably see this with some of the other clients that you're working on in the space or working with on the space. The challenge with Opportunity Zone funds is they're unlike private equity funds because you need to manage the capital raise in the context of the deployment. Sitting on capital, and I've seen a lot of announcements on really large Opportunity Zone funds that are being raised, and I'm sure many of you have seen them as well. The concern we have is making sure that we've got the ability to deploy those funds when raised. And so we're doing kind of a rolling raise over the course of a kind of a 2-year raise so that we know that we've got adequate pipeline to be able to utilize those funds the way that we've committed to investors we're going to utilize them.
Erik, how about yourself?
You know, we see some advantages and disadvantages to having the 180-day window of a capital gains event from when an investor comes in. I mean, obviously a disadvantage is that it has to be capital gains that's invested into these funds in order to receive the tax advantages. However, when we're looking at investors, you know, the good news is they do have a 180-day window where they get to decide whether or not they're going to pay taxes or invest in an opportunity fund. And we really think that's an easy decision. Investing in an opportunity fund, it's going to be kind of like the new 1031. And it's going to be a decision more of which opportunity fund are you investing in and less are you or are you not investing in an opportunity fund.
Yeah, I mean, if it's okay with you guys, I'll stick with some of the questions that focus on the timing parameters around the program, because that seems to really be sort of one of the key points here for both investors and the funds, you know, in terms of when they have to get their money in, when they have to deploy it. So, I mean, along those lines, as you know, typically in private equity real estate, you're looking at a 5 to 7 year hold, maybe 3 year on the short end, but usually by the 7 year, point, the funds are looking to sort of, they've done whatever they're going to do, whatever value add they're doing with their assets. And here, in order to really maximize the benefits under the program, Todd, as you pointed out, you've got to have a 10-year hold. Is this impacting who you expect to invest in your fund?
Yeah, I mean, in particular, again, I think we've got another portion of our business that does focus on more institutional capital, more that 3 to 7 year investment horizon profile. Here, I think again, by the very virtue of the policies underlying the QOZ legislation, you're investing in areas that are going to take longer to mature, and so investors that can take a 10-year or more investment horizon. And certainly in the kind of yield-starved environment we've seen over the last 5-6 years, there's more people that are interested in saying, how can I generate a high single-digit, low double-digit kind of cash flow on my investment, and if I can do that, I'm prepared to hold on longer, and if I get this extra tax benefit in year 10, all the better.
Right. So potentially more family offices then than less institutional? Is that what you're seeing?
Yeah, so we again, very non-institutional the way we're looking at it. Private capital, in the Bay Area in general, obviously there's a lot of embedded gains in folks that have successfully invested in the tech world over the last 10 years, and so there's really an opportunity for folks to get some asset diversification, take some of those. It's the one thing that Erik just mentioned. 1031 is something that we're all familiar with as real estate investors, but that's very real estate centric, right? You sell a like-kind piece of property, you invest in another like-kind piece of property, you defer the gain. Here, one of the big benefits of a qualified opportunity zone is that you can take other asset classes. You can take low basis stock, you can take a piece of artwork or something else, and you can establish some asset diversification through the QOZ fund platform, and we are seeing people that are making those decisions.
Yeah, well, sorry, that's a great point. I mean, you were talking about the tech investors. I mean, Erik, are you seeing people who are sort of new to the real estate world coming in through this then?
Absolutely. We're seeing a lot of investors that have kind of been sitting on the sidelines are now having an opportunity to compete in this type of space because of the tax benefits of opportunity zones. Specifically, we're looking at investors that are family office, wealthy individuals, tech investors, venture capital funds, and really any type of private individual or corporation that has capital gains. Overall, our investors are typically sophisticated investors that understand the nature of a long-term hold and how that benefits real estate. As Todd mentioned, typical real estate funds are 5 to 7 years, and we're looking at a 10-year hold and focusing on the timing of 10 years when we're really looking at least in our fund, a 1-year raise, a 10-year hold, and 2 to 3 years to liquidate. So we're looking at more of a 14-year fund. And so what we're getting is we're getting the benefits of almost having two funds bookended together, where after 5 to 7 years, we will refinance our assets after they've stabilized, pull that money out, and then redeploy it into another round of development.
Great. So, I mean, to date, at least from the lawyer's perspective, it feels like we've gotten sort of more guidance than hard and fast rules with respect to this program. We're still looking to the IRS for guidance on a number of opportunity zone related issues. I mean, aside from the roughly $6 trillion of capital gains that are sitting out there ready to be deployed, how did you get comfortable sort of investing in opportunity zones and taking advantage of this program so early on?
Honestly, when we started this in mid-2018, it wasn't very comfortable. I mean, there were a lot of regulations that hadn't come out. I've been a real estate developer for my entire career, and when I saw these opportunity zones come along, it seemed like the perfect fit for not only my skill set, but also us wanting to take advantage of some of the areas in the Bay Area where I've done a lot of work. Yeah, so we weren't very comfortable. It was nice when the regulations came out in October and we had a little bit more guidance. It really, helped us sort out like what type of entities. It gave us the 31-month instead of the 6 months in order to deploy our funds. But what we wanted to be is we wanted to be the first out there in the market. We wanted to take the risk so that we could take advantage of this opportunity. We could go out and be the first on the street to be able to attract investors and also to go out and pick up the choice properties throughout the Bay Area that we really want to invest in.
It was hard. So our first single asset deal was in Arizona, downtown Phoenix, and we did it actually with a local partner, Jackson Square. And it was very sophisticated. They're very sophisticated. We've been around the block a time or two, and it was really difficult because the uncertainty around it, always raised more questions. We had a great team of tax and legal advisors that helped us navigate as much as we could some of those issues. But the good news is when the regulations came out in October, or at least the first round of regulations came out in October, we were right more than we were wrong on kind of how things would shake out. And so, through that, we've kind of gotten a lot more comfortable. We've built a team. One of kind of the lead people in our firm that is running our QOZ platform is a former securities lawyer that kind of just came over to join us. And so we're very focused on, dotting our I's and crossing our T's. There's another meeting next week, that the Treasury's going to, I think, respond to some of the comments that are out there.
Hopefully more questions answered.
More questions answered.
As opposed to more being raised.
Right. Hopefully we don't have another government shutdown that kind of defers that even longer.
Right.
So we're just, I think we're hoping there's, a handful of items out there that would really, I think, help the industry, eliminate some of the continuing questions, but hopefully that'll be soon.
And, also sort of to overcome some of the uncertainty from the IRS, it's really been helpful for us, as you mentioned, some of your advisors. We've hired some of the best advisors in the country, attorneys and accountants and compliance officers, to really make sure that we're going to qualify as an opportunity fund. Overall, we think that having those people in place is going to be extremely helpful in navigating all of the regulations. And because the IRS, it is unclear, we think also, as Todd mentioned, that we're really trying to meet, sort of the spirit of the law. And in these initial phases, as long as we're really trying to walk that line, we think the IRS will give us a little bit of forgiveness.
Yeah, it'll be interesting to see how that plays out in terms of how much flex they might have. I mean, we have a client that already, actually quite a conservative client, strong developer, and they inadvertently tripped over the 6-month testing rule. They took funds in September, and they didn't realize come December there was already going to be their first test, and already it's sort of, okay, we have to return the funds and then start the process over. So, I mean, you guys are walking through a minefield here with little guidance so far from the IRS. In terms of fund strategy, talk about single asset versus multi-asset funds. Again, typically, private equity real estate, we see somebody go out, they raise $250 million, $1 billion, or if you're Blackstone, $1 gazillion. And the objective is to acquire multiple assets, right? You spread your risk out across your entire fund. You've got a nice portfolio of assets. You're able to sort of buy and sell at different times and keep a cycle of assets. But it seems like there's a lot more complexity and uncertainty surrounding a multi-asset qualified opportunity fund. And I'm curious to hear from both of you on this, on how you're structuring your fund, and also bearing in mind, how, for example, are you dealing with the sale of investor interests in a fund that has multiple properties that are, it's going to need to be liquidated over time unless you plan on just doing portfolio sales? Todd.
Sure, and it ties to a little bit of the answer I gave earlier. So we look at really three complexities in a multi-asset fund, with one benefit. The benefit is diversity. The complexities, and hopefully some of those will get answered soon, are one is, capital raise and deployment, making sure, as I mentioned earlier, that you're raising capital consistent with the pipeline that you have to deploy it. The second is sale and reinvestment. How is the IRS going to treat that recycling of capital within the fund itself? And then the third is, as you mentioned, kind of how do you liquidate a fund? Right now I think there's some uncertainty on whether you need to sell partnership shares, whether you can actually sell the assets. I think that's...
Still waiting on the IRS on that one.
And I think even the congressional letter that was released last month tried to address that issue and ask for guidance on behalf of constituents, saying like they need to know what an exit plan is in order for this to be a successful policy.
Erik, I think you mentioned you're doing a multi-asset fund.
That's right. And to a lot of what Todd said, there is a lot of complexity. Todd, I think you could probably speak better to setting up a single-purpose fund as you've done it. But overall, I can give you a couple of pieces of guidance that we've done to structure our fund to overcome some of the confusing programs and regulations the IRS has come out with. The first is our fund is structured as a REIT. And because we're structured as a REIT, the reason we're structured as a REIT is because after the 10-year hold period, if we want to liquidate our assets one at a time, we have to be a REIT and able to give our investors the benefit or the tax-free advantage of the 10-year hold and all of the profits from the fund being tax-free. Secondarily, in order to meet the test where we deploy all of our money within 31 months of raising it, we have formed a second entity below our REIT, our operating partnership, which our REIT will invest into our operating partnership. And if you invest into the operating partnership, it qualifies as an opportunity zone asset. And it gives, if you have a plan, that gives you the 31-month runway in order to do your investment.
Interesting. Are you also structured as a REIT, or are you doing?
No, we're a traditional LPA, limited partnership agreement, that will have specific single asset subs. And that's where we'll place debt and do some of the traditional kind of real estate, leverage and construction elements.
Right. Sorry.
So, overall, when it comes to single-purpose opportunity funds versus multi-purpose or multi-asset opportunity funds, obviously it's a lot more difficult to structure multi-asset opportunity funds. But single-purpose opportunity funds sort of have their own challenges as well. What we really see, as who will utilize that type of fund, besides Todd here, is, we look at Google coming into downtown San Jose, and some of the property that they've purchased for their 8 million square foot campus is in an opportunity zone. They'd be the perfect group to be able to come in. They have a lot of capital gains. They can structure their fund, and they have an army of attorneys and accountants that can be sure to do all of their back-end compliance so that they can make it work.
Right.
I think just to add to that, and I should have been clear, we are doing a multi-asset fund to follow our single asset fund, and we do see a lot of requests from investors for the single asset fund, just because there's just better transparency. People want to say, I know I'm investing in this.
And is that with respect to investors who have invested in real estate before? Or is that sort of new to the party who like that one asset?
Yeah, I would say it's a great question. It's more educated real estate investors, right? They know what they like, they know what they don't like, and therefore they want to make a conscious decision on their investment. We again think that there's a real benefit to the multi-asset fund, even though there's a lot of complexity, just because again you do get diversity. Our fund is going to focus, just given some of the nuances of the QOZ requirements, we're going to really focus on opportunities outside California, and we do invest throughout the Western U.S., where speed to market, lower construction costs, things that unfortunately we don't see a lot of in the Bay Area, can benefit a fund. Investing here in the Bay Area obviously has a ton of strengths, just given the kind of the quality of the assets, the quality of the economy. But there's just different paths to a successful fund, I think.
So along those lines, when we talk about asset classes, we know under the fund rules, no golf courses, no tanning salons, no liquor stores. Erik, are there any particular types of assets that appeal to you for your fund? And is there anything that makes particularly good sense when thinking about opportunity zones?
Of course, assets have to be income-producing assets because you're not allowed to sell properties through the duration of the fund. But What I will say, we're going to be focused on a variety of asset classes in our fund. We're very location specific in the Bay Area, specifically focusing on the downtown San Jose Opportunity Zone and some of the opportunity zones in Oakland. So where we are focused geographically, we are diversified by product type. We're going to be doing office, hotel, market rate, multifamily. We're going to be doing student housing, senior living, assisted living, memory care, really a whole variety of product types.
Todd, what was your first project? You mentioned it was in Arizona.
First one was multifamily, so kind of an emerging submarket, warehouse district of downtown Phoenix, where you're seeing a lot of kind of the early signs that we saw in South of Market here, where the creative class, a lot of millennials are self-selecting to move down there. Starting you see your first co-working space, kind of interesting bars and things like that. From a fund level, we're going to focus on multifamily, market rate multifamily, as Erik said, limited service hotel, kind of things that again we can deliver quickly from a construction standpoint, and also can really start delivering cash flow.
Yeah, are you seeing people come in to opportunity zones who perhaps they're not used to investing in those particular markets before, and is it new competition, or are you expecting to see sort of the same players who are now just going to take advantage of the opportunity zone program?
Probably a combination of both. I think the one issue we're facing as we kind of develop this pipeline is that there's just a view, and I think hopefully it'll fade with time, that just because your property is in a qualified opportunity zone, it's worth more. Our view is that it's not, whether we're a buyer or a seller. It's just that it can allow a project to happen. And that's, I think, something the market's got to work through, because I think there's a bunch of transactions that are stuck because the bid-ask of the buyer and seller is kind of gapped out because there's a lot of froth. This is a very full room. I've spoke on BISNOW panels before, and there's a lot of interest in this program, obviously.
We look at it somewhat the same way, that land values will be somewhat the same. As a real estate equity fund with the advantages of an opportunity zone behind you, we're out there competing with other real estate equity funds that raise money from endowment funds and pension plans, so they already have a tax-free nature built into their returns. Right. So it's not like our projects are going to be somewhat better than their projects. This program was built really for two reasons. The first is to improve these lower income areas. For example, in downtown San Jose, we have our first project. It's going to be an 80,000 square foot office building, and it is going to be roughly 300 feet from the new San Jose BART station that will be built in the next couple of years. It's a really up and coming area, and as we do more and more projects, it's going to create a synergy for this area, and we're really hoping that's going to just push San Jose forward. At the same time, the other benefit is really for the investor. A lot of investors that are sophisticated have been sitting on the sidelines because they don't get these types of advantages. And now that they have these advantages, they'll be able to be moving their investments into these types of properties. And that's good overall for the economy.
Well, while I have a host of additional questions for you both, I'm getting the signal that it's time to wrap things up. But I thought I'd open it up to the audience first and see if we had some questions out there. Nick, how do you want to?
How does it work if you've already acquired the property in the fund and then the investor sells their assets afterwards and reinvests? Because I understand that the gain has to be recognized before the purchase. Basically, the rule is that you have to have the gain, right, and then within 6 months after the gain, you have to acquire the property. And these funds have already acquired properties. And if we say you acquired the property a month ago, we sell our Uber stock today.
Right.
Do you understand my question?
Do you have a timing issue?
Yes.
In that the fund already owns the asset, you haven't realized your gain yet, and whether or not you can invest in the fund?
Yeah, it sounds like, if I'm understanding your description of your intended strategy, it sounds like you're intending. Pardon? I have a new question.
Yeah, I'm not quite sure I understand the exact kind of sequencing of your question if you're asking from an investor standpoint. I think if you invest in a qualified opportunity fund, and that fund is a multi-asset fund, you can take advantage of the program, but that might be something that you kind of ask your tax advisor specifically, because I just wasn't quite sure of the details. You need to make an investment in a qualified opportunity fund. You don't need to acquire an asset. Maybe we can follow up offline, because I'm not sure following up on it.
Yeah, quick. So it sounds like from what I'm hearing, your intended strategy is to come out of the ground with original use. Have you looked at or considered, is rehabbing not really going to pencil out, given that you have to put in your basis exclusive of land plus $1?
So absolutely, rehab and repositions are going to be a part of our business plan. We have to meet the substantial improvement test, and that has been further clarified through the IRS regulations in October. And really what that means is putting in a one-to-one value into your project of the value of the building minus the value of the land. So, for example, we're looking at a project in San Jose right now. The purchase price of the building is $17 million. It needs about $10 million in improvements to, get a tenant in there. But what is the value of the land? So what we're doing is we are having an appraisal done to make sure that the land value is such that we will be able to substantially improve the property so that we can have a qualified opportunity fund asset.
Awesome. Thank you guys very much for kicking us off like that. That was a great panel. Big round of applause.